Ladies and gentlemen, it's 2026 and Duty Honor Real Estate is back, and we are ready to start this year off with an incredible guest. This guest is going to help us understand mortgages that are mission approved. He's going to demystify all the different loan products out there: VA, FHA, USDA, non-qualifying, conventional, you name it. And it's very special because this lender has been with me for years, and I have had the privilege to learn from him. And a lot of our clients have had the opportunity to leverage him to win in any market. So let's welcome Mr. Philip Chavez.
Thank you, Brian. It's too nice, man. I appreciate it.
No, yeah. And, lending is kind of a dense topic, right? This isn't your typical real estate conversation, but we got to get into it because we're going to make it fun and very fast. So let's talk about who you are, because if you guys don't know, Chavez started in the mailroom, Wells Fargo, and literally worked his way up to the point where there's rumor that he worked on Tom Brady's loan at one point. And what I love about this rags to riches story is that he had humble beginnings and he worked his way up to understand every facet of a lending. And for example, he's done origination all the way to post-closing. And now he's starting his own brokerage, Two Doves. And so talk about the different types of lenders that are out there and what you do differently.
Well, I started at the very beginning, so I've seen it all. We have few different types. You have direct lenders, for example, you'd have Ent, Wells Fargo. They sell directly to the Federal Home Loan Bank, for example, or Fannie Mae, Freddie Mac directly. You have correspondent lenders, okay? Kind of a hybrid between a broker and a direct lender. They have their own in-house underwriters, in-house funding team, closing team. Then you have brokers, which is technically what I am now. And brokers shop for you. There's a saying, brokers are better. So over my past 25 years, I've learned that sometimes the hard way. And from a broker standpoint, really you get the same rates pushed out as correspondent direct lenders. But if you can structure your business wisely, not have the overhead, you can really push out some phenomenal rates for the consumer, and not just rates, but service. I can move a loan faster than probably anybody out there, and I'm willing to accept the challenge.
Well, thanks for giving that the differences in the lending, entities. And for correspondent, is that like a Rocket Mortgage and a what's the famous one?
Yeah, UWM.
Yeah.
They do have correspondent channels would be a good way to look at it. So you have all of these different investors out there: Penny Mac, United Wholesale Mortgage, New Res. Anybody you can think of. You can go directly to them, right? You can go through a broker. So they have different channels set up, and you essentially are signed up with them. You have to go through some reps and warrants. And depending on how you want to structure your business, it can help the consumer with interest rates, things of that nature.
And when do banks get involved in this channel?
Banks are probably the biggest direct-to-consumer channel, if you will, where you go in, they sell directly to Fannie and Freddie kind of thing. They have their own capital that they can use. A lot of it, brokers really became prevalent after, I guess, the housing crisis in 2015, simply because, just like that movie, Too Big to Fail, some of those banks started going under, the rules started changing, So
USA is a direct lender?
They probably, because they're probably using their own capital. They're selling directly to Fannie and Freddie.
And then Veterans United is a correspondent
lender? I would say
lender?
correspondent because they're not really necessarily, they probably can sell directly to, though, because just because you're a correspondent lender doesn't necessarily mean that you can't sell directly to Fannie, Freddie, FHLB kind of thing. So,
and then a broker would be like you, so like more of an entrepreneurial licensed lender.
Correct. Yeah. Where I would go to all these different investors and find not only the best rate but the best service, because not all lenders are created equal in the terms of, and neither are all investors created equal.
That's good.
Yeah, so it's you definitely want somebody that knows the business to actually ensure. Like there's an unnamed investor that I would never send a loan to anybody ever unless they begged me to do so.
And so if you're a bank or a direct lender or correspondent lender and you have that investor that may be limiting, for that borrower or for that product, it's actually an advantage that you're a broker and you don't have to worry about that type of investor.
Well, and absolutely. And not only that, let's look at rate locks, for instance. Okay, so a lot of times you'll hear that, once the rate is locked, it's locked. Okay, so what if the market gets better? Okay, a lot of folks won't change the rate on you. They'll make you sign an agreement saying, hey, this rate is locked. If the market improves, it is what it is.
Wow.
Kind of thing.
And I imagine pricing varies, right? Because if I'm thinking working with USA, Veterans United, or even brokers, I imagine there's a variation in pricing.
Oh,
Closing
absolutely.
costs.
Yeah, well, and even if you look at it this way, you have guaranteed rate, right? Okay. They have, a football field named after them. They sponsored a bowl, okay, like a college football bowl. The owner of UWM also owns the Phoenix Suns, I believe. Well, that money comes from somewhere, right? It comes from the consumer. So really, brokers, for instance, like me, I process my own loans. I do everything from beginning to end. I can push out rates just because I simply don't have to pay or pad my numbers to sponsor these different things, So I think from the standpoint, brokers are better simply because we move faster, we have better rates, we get more done.
Yeah, and every business model is different, right? And USA, Veterans United Guaranteed Rate, or, entrepreneurs like yourself, they all have different business models. So it's good to see, I think, options, right? And it's good to see that there are people who spend money on marketing and trying to get their name out there versus maybe others that just don't have overhead, right? And they can probably pass those, gains, if you will, or those savings on to the borrower in a lot of different ways.
Well, and it's not just about, I think it helps being in the business for such a long amount of time because for me, I know where I need to put money. Okay?
Yep.
Like I'm very efficient with the direction in which I utilize borrowers' funds. I mean, because
That's
the
right.
borrower is paying me. So at the end of the day, I want to utilize that money effectively to continue to help borrowers.
No, and I love what you talk about in terms of time and service, if you will, right? You have agents and lenders and title reps, you name it. They've been in the business for X amount of years, but that doesn't mean there's quality, right? And what I love is because you've done almost 2,000 loan originations from when you first started to all the way to now. And that is a lot of data points, a lot of experience that, I've always called you Chavez GPT. I prompt you and then you always have a great answer that helps me just be more empowered and educated for my clients to help them maneuver and advise them on their loan options, right? Now, I'm not advising them as a licensed officer, but I at least know what they're receiving. And I'm able to help them essentially counter back to their lending entity. So, no, that's incredible that you kind of gave like what is a lender and what type of lenders are there. Now, I think what we need to do is get in and give the people what they want. And they want to know about these loans. So the first one we're going to start with is the VA loan, the Veterans Affairs Loan. And this is an incredible loan, obviously special to a lot of military, near and dear to my heart. And it's an earned benefit. It's a benefit that veterans have sacrificed for. They raise their hand and they literally pledge theirselves to the government, to the military. And in return, they have all these benefits. And one of the benefits is the VA loan. And I think it's incredible because it gives them, honestly, an upper hand, I think, than to your, let's say, civilian counterpart who just didn't, do a service, and there's nothing wrong with that. And I love how they distinguish that, and they really provide a product that I think is almost invincible. And so, a couple of high level stuff, because I could talk all day about the VA loan, but what are these high level characteristics of a VA loan that you like to talk about?
Oh, I did the best loan of its kind by far. Like you said, service earned, not a service given. And it's absolutely true, because I think there's a lot of big misnomers with the VA loan, just things that people think are true that really aren't, myths, if you will. First and foremost, 100% financing. You can't beat 100% financing. Not only that, it actually technically goes over 100% because they allow you to finance the funding fee as well. So over 100% financing. They're also the only ones that will allow debt reductions for excess credits, which can be extremely beneficial in a buyer's market. Because let's say you have 20,000 in credits, conventional FHA, you can leave money on the table if there's not enough closing costs to pay for all those credits. Well, the VA does a huge service by allowing them to use the excess credits, the veteran, towards debt reduction. And we've had situations where we've paid off cars. We had folks go into it debt-free. So you buy a house debt-free, and then you're just paying the mortgage payment. No other loan allows for that. But not only that, even after the fact, the benefits continue because you got the VA interest rate reduction loan. A lot of folks are going through that right now where they locked 6.25% last year. You're getting 5.25% now. And all of a sudden, you're saving $300, $400 on your payment after the loan closes. And it's a non-qualifying loan. You can't beat it. It's the best loan of its kind. So at the end of the day, VA, if everybody could do it, they would. Okay, I can't say enough good things about VA. And if there's anybody out there that's like, hey, the appraisals are too... VA is the only ones that has mandated turn times on VA loans, 7 days. You can close a VA loan in 10 days, which is the minimum required by law. Conventional, that's a lot tougher to do because you have to go through appraisal management companies, things of that nature, where you don't gotta have a liaison with the VA that will help because the VA wants to put the veteran in their home, plain and simple. They really do. So, best loan.
No, I love how you talk about it because I could see that passion. And what's near and dear to my heart are credits, right? Interested party contributions, IPC. And so every loan has a max, and it depends on your down payment. But what I love about the VA loan is just how user-friendly it is when it comes to utilizing concessions. Because in this market, you can get your closing costs paid for. You can get interest rate reductions. But now with the VA loan, you can get debt reductions. And that's huge. Literally, like you said, we've had clients pay off their car bill. Because, if you guys know, you're probably getting charged 20% for your car, and then your credit cards, you name it. And then the administration right now is talking about, capping that at 10% in credit cards.
Well, and it's more effective than putting a bunch of money into points.
Oh, that
right?
too.
Yeah,
that too.
A lot of lenders will tell you you have too many credits, we'll throw them into a temporary buy down or point. Is that really the best bang for your buck when you have an 18% credit card out there that you've probably been utilizing to help your family move across country? We pay that off through extra credits, and so it helps to have an educated lender. And I'm not knocking all lenders, okay, but I will tell you there are some out there that really are just in it for the money, right? That's all that they're trying to do. And that's 90% of the reason that I created Two Doves Lending. Even seeing it from people that you held highly, definitely trust but verify with any lender that you're working with.
Yeah, without a doubt. There's obviously people who are more transactional than they are in terms of educating, and it's great to hear that. One thing I wanted to talk about is, there's no mortgage insurance.
Oh, well said.
And so, with no mortgage insurance, that's huge when you got property insurance coming out the yin yang right now. And so as cost just keeps getting more inflated, your goal is to reduce your mortgage, how can I keep reducing this mortgage? Because you can get a house with an HOA, a metropolitan district, then the PITI, and then on top of it, you got mortgage insurance too.
Yeah, let's define mortgage insurance because the question I get a lot, or they're surprised because some folks think it's homeowners insurance. It's not homeowner. Mortgage insurance, or often called PMI, private mortgage insurance, is just a cost to protect the lender. That money goes absolutely nowhere. Okay, so you're just paying additional on top of your mortgage payment because you didn't have sufficient down payment. So it's really kind of a penalty to the borrower, because for a long time borrowers couldn't buy a home unless they had a 20% down payment, and then all of a sudden these private mortgage insurance companies came out in the 80s that are like, hey, we'll protect your mortgage, but they have to pay us a monthly premium. So private mortgage insurance, like, I think all insurance is kind of a scam, to be honest with you. But like it pays to understand what it is, because there's different levels of mortgage insurance as well. And we probably even get into that with FHA. But if your credit score is better, you're going to get cheaper mortgage insurance. There's programs available like Home Ready, Home Possible through a conventional loan that give discounted mortgage insurance.
Wow.
So there are ways, but that mortgage insurance is definitely
It's a nail biter. Ankle
it's
biter.
an extra cost.
It's cool. We had one borrower where they actually worked with another veteran, and then they did their entitlement together, and it was respective. It was on the west side. I don't know if you remember.
Yeah.
And they actually, in the end, they used each other's VA. They weren't married. They came together, and they lived in the unit. I don't know if you remember that. And then when they sold, the other one just bought the other person out, paid the value that they had, and then the entitlement was all on the remaining owner, and then the owner leaving, he had his VA right back again.
There's a lot of creative things you can do with VA entitlement.
Oh yeah.
It's amazing, because not only that, a lot of folks think that you cannot have a non-occupying co-borrower on it.
Yeah.
Well, if they're a veteran, you sure can. Family member.
Look at that.
Dad buying. We've done that situation. You can also have non-married applicants.
See?
So there's lots of different variables to VA entitlement. I mean, you can reuse it too. I mean, you can go into bonus entitlement. I've seen folks with 4 or 5 homes under VA entitlement.
Isn't that crazy?
Yeah, and as long as it's your primary residence, because the VA understands. That's the beauty of a VA loan. There's common sense in the underwriting process. And I think we've lost some of that ever since 2015 with our new rules and things of that nature. But VA, we'll look at it as a whole for the veteran, and if it makes sense and they're going to live in it as a primary, the VA is going to do everything to try to get you into that home.
I always argue with you, and I always complain, why can't all the products mimic the veteran loan, right?
Oh, yeah.
Because there's so much just flexibility, I think, with the VA loan, that in this time where home ownership's at risk, everything costs money, no one can get approved. They're depending on rates, and if rates go down, that means asset prices go up. I mean, it's crazy, right? Yeah. And to have that ability with the VA loan and to empower them in the beginning of their career all the way to whenever they decide to get out and retire is literally gold. And, I wrote an article on LinkedIn about, I wish we had some sort of conscription, some sort of after high school, you have the option to go to the service or you go to university. But I feel like we need to almost mandate it where you need to serve for at least 3 years. And I think that would help not only the student debt, but also helping people have this benefit. And it's only 3 years.
I would I told Brian, I always tell Brian that I would re-enlist if I could. I'm too old. Too old and fat now. But I can tell you, because it is the best.
It's so good.
Benefit of its kind. And to answer your question, why does every loan have those parameters? Risk. That's all it comes down to.
Exactly, because you said it. No investor is the same. Not all investors are the same.
Well, the reason VA gets better interest rates and the reason that the underwriting requirements are a little less stringent is because the
non-recourse.
Well, the VA guarantees 25% of the loan amount.
Boom.
To the right there. It's less risk for a lender,
all
so
day.
they're going to push out better rates. And Any government-backed loan, FHA, you're going to get better rates.
And when you're working with a lot of different agents and they're coming to you and they haven't even worked a VA loan, do you got any pro tips for agents that are coming to you and they're like, hey, I got a veteran buyer, heard you on the podcast.
Yeah.
What kind of tips could you give them to help them, have better synergy? Because they may not be a veteran. They may not understand what a VA loan. Anything that comes to mind?
Well, they should call me. Okay, I really mean it. Because here's the thing about me, and I think you know that, is I don't mind answering questions.
You
people.
don't?
Yeah, because I think that, unfortunately, misinformation spreads, right? So I can't begin to tell you how many things I've heard that people aren't able to do. Like even reusing your VA loan, okay? And they're like, no, you can reuse your VA loan. Or that you can't do the VA IRRRL over and over and over again. So really, I would encourage utilize your resources. Verify what your lender is telling you. I really mean it. Like, don't verify on ChatGPT. Forgive me, okay? It can be wrong. But I've had other agents call and say, hey, what do you know about Phil? Okay. Yeah. And I don't mind that, because at the end of the day, it's all about holding everybody in this market accountable. Okay. It really, really is. So if they're not willing to call me, okay, the best advice I can give you is the VA selling guide. Okay. You can absolutely, there's no secrets in the world of lending. You can verify every single thing that I throw out to you, that your lender throws out to you. No offense that an underwriter throws out to you, okay? I love underwriters, so any underwriters out there, okay? But they are the bane of our existence, okay? They really, really are tough, but it's their role. They're there to protect the company, right? But all they're doing is checking everything on the VA selling guide, the Fannie Mae selling guide, the Freddie Mac selling guide, and FHA selling guide. You can Google these terms, and it will give you the literal Bible of mortgage lending, okay? It's very user-friendly. You can go in there and you can say, hey, rental income. It'll show you how we calculate rental income, okay? But any who has the time, right? That's why you have resources kind of thing. But you said a smart thing at the beginning of this podcast is that you need to understand the role of others in order to do your job well. And I truly believe that, because one of the reasons that I go to your guys' meetings, sure, I'm never going to sell a home, but those questions do come up. And to understand how everything fits within each other, it's a very symbiotic world.
I like that. And that's a great pro tip. Understand what the other stakeholders in the deal are doing and how that affects the overall deal and the borrower. So, no, I love it. And I love how you bring up accountability because in this industry, professionals welcome accountability. And so that's very important. And so really thank you for getting into the VA loan. Now, I feel like the FHA is like the sibling, the other sibling, right?
Yeah, well said.
Of like the government-backed loan, right? And so let's talk about the FHA. Does it even have advantages?
I will tell you it does now, okay? And and I shouldn't even just say now. It's always had advantages for borrowers that credit is a little bit spotty, for lack of a better term.
Okay, yeah.
Their credit requirements are not as stringent as a conventional loan. They would probably be more along the lines of a VA loan when it comes to credit requirements. 580 minimum FICO score versus conventional, you're looking at least a 620. But even at a 620 on conventional, you're not going to get favorable pricing or rates. So there's a wheelhouse for FHA loans, especially for first-time home buyers, for people just starting out. Because one of the advantages is it has lesser down payment requirements. So that 3.5% down is definitely a true advantage for anybody starting out in life. Plus, with the lower interest rates, the rate is going to be more on par with a VA loan, current market, say 5.5 today, then conventional, you're looking at 6 1/8. So that rate difference is definitely something to take into consideration. However, the mortgage insurance, as you alluded to earlier, is a little bit higher, okay? But they recently discounted it from 0.85% to 0.55%. That's your monthly premium. So, that's over a 30% reduction, which is helping people get qualified. So I'm actually doing probably more FHA loans in the past 2 years since that mortgage insurance premium reduction than I have in my whole career prior
But
to 2
can't
years
you
ago.
pay off the mortgage insurance for X amount of months if you got credits? Can credits, since we talked about IPCs before?
Yeah, FHA you wouldn't be able to
Okay.
do that. So single pay premium mortgage
Yeah,
insurance. Conventional, that's where like it's
Okay.
just see it great questions, because that's why it's important to really understand like what the lender is doing during the pre-approval process, because all of these thoughts are going through my brain, because at the end of the day I just don't want to put you into, oh, okay, you're going to go conventional, you
Yeah.
know, kind of thing. Even though you qualify, the FHA might make more sense to you, you know, especially if you don't have the 20% down, or if you're only doing 5%, because conventional becomes advantageous the more money you start to put down, because then your private mortgage insurance is going to get reduced at that point. So overall your payment is going to get reduced. And it's probably a good time to even talk about payment, because your payment, just before we get too deep, is always going to consist of 4 things. Okay, so you have the loan portion, which is your principal and interest. Okay, then you have your taxes and insurance, which is your escrow account, and then you possibly have the private mortgage insurance, right? And so that would comprise your payment, because HOA dues, even though we collect for them, I guess, that's not part of your mortgage payment, it's a separate check elsewhere kind of thing. But just knowing how your payment works, and if you can get rid of that 5th element in private mortgage insurance, that's the ultimate goal. And you can do that through refinancing if you have the equity. So FHA, even though you get into an FHA loan, you're not always going to pay that mortgage insurance. It is life of the loan if you stay in that FHA loan. However, you'll probably refinance. Most people do it within 7 years.
You know, we talked about concessions before, and I love concessions, especially in the buyer's or balanced market. But you could leave money on the table. I remember when you first told me that, you're like, Brian, you got too many concessions. You're going to leave money on the table. And then I look like a loser to my client, right? You know, because I got them too much money and the product limited it. So why is that? Why do they limit concessions?
Yeah,
Even what if you put more than the 3.5 down?
Yeah, so every loan product has their own limitations to interested party contributions, is what we call it. So anybody involved in the transaction, lender, agent, seller, they can only contribute so much money to the transaction, because the government doesn't. They put limitations because they don't want it to be considered an inducement. Okay?
Gotcha.
Like, hey, you buying my property, but why are you buying it? Because they're giving you all this money, kind of thing. So FHA actually, since we're on there, 6%. I mean, that's pretty good.
I mean, that's a lot.
Can't really.
And I am getting a lot.
Yeah, 6%. That's a good IPC.
That's a good amount.
Okay.
That's a good amount.
VA 4%. Okay,
Yeah.
so 4% interested party contributions of the purchase price. So let's say you're at 400,000. That's what, 10 grand. That's not right.
No,
Okay.
but okay. I understand.
With that being said, okay,
Yeah.
then you have conventional, okay, and then conventional is based upon the loan to value.
Yeah.
Okay, so depending on how much money you're putting it down, it can range from 3 to 9%. Okay, if you're doing 25%.
That's
down,
wild.
Yeah, they're like, yeah, that's cool.
9%.
Yeah,
That's insane.
Just a way to mitigate risk, you know.
Yeah.
So they're like, but once they know you're putting 25% down, there's pretty much the risk is out the window.
But you know, I think the jobs market report came out. I think was it last week or this week?
Yeah,
it's
a
coming
little
out.
less than expected.
So a little less than expected. But isn't there some job limiting factors that you need for the FHA?
So the number one thing with FHA loans and things that have bit me personally is time on job for FHA. They're going to honestly require 1 year that you've been on job. I've gotten away with 6 months, but I can tell you was a miserable situation for all parties involved. And it was totally my fault too, you know. So 1 year you need to be at your job for an FHA loan. If it's a little bit less, just get in contact with your lender kind of thing. Because even though there's rules, okay, there are exceptions to every rule.
No, understood.
Okay, so like definitely got to just be on time on job, and then 2 years time in job. But aside from that, I mean, you got to be careful for any kind of income if W-2 versus 1099 or self-employed, or you're a new business owner. Because if you're 1099 self-employed, or you don't have 2 years of tax returns, commission only kind of thing.
Agent.
Yeah, you have to have a 2-year history. It's a flat 2
Minimum.
years. FHA is a hard rule. Like, you might be able to get away with less on a conventional loan, but FHA is like, dude, no.
So you young agents out there, get those 2 years in, do very well, and you got FHA.
Yeah, and it's a great program right now. It just helps everybody to get in their first home, build equity. Then when you sell, you got a larger down payment. You know, if you can go conventional and you do have the down payment, even though the rate's a little bit higher, the long-term savings would probably be more beneficial on a conventional loan.
What about appraisals? Anything different with a FHA appraisal or a VA appraisal?
FHA appraisals and VA appraisals get a bad rap. I will tell you.
Yeah.
Okay, like let's concentrate on VA, because FHA is a little bit more stringent than VA. So VA is checking for health and safety. That's all they're doing.
Minimum property requirements.
Correct. Yeah, they want to make sure it's inhabitable. There's not loose wiring. There's not leaky plumbing, and the missing railings is a big thing. And you get that a lot, or even peeling paint. Yeah, you nailed it. Peeling paint, and just making sure that the paint chips are swept up, kind of thing, because that's actually a lead-based paint requirement. Okay, prior to 1978, so that could come up. But those are all pretty simple things, really. If you're going through your home, you're getting ready to list it, just think out loud, could this pose a health or safety risk? That's VA. Okay,
Gotcha.
FHA, they're going to do a little bit more from the mechanical side. They're going to go into the crawl spaces. They're going to go into the attics. Okay, they're going to do the health and safety, but the minimum property requirements are a little bit more in depth for an FHA loan. So
yeah, it makes me remember we did one, I think in 2024, FHA. I know we had the concession problem where I had too much and we had to figure out how to spend it. But what I love about it when it comes to inspection objections when I'm representing the buyer is that you do have an appraisal that helps you legitimize your objection as well, right? So in that case, you can build strategy. Maybe do the appraisal first.
Well, yeah, absolutely. Not everything is a bad thing. There's silver linings, right? And you've done that personally, okay, where you actually got more things fixed because you knew what the appraiser was going to call out on, and you were proactive about it, and it actually benefited your borrower or your client. Absolutely.
And so think about using all these resources, all these characteristics of the loan to help your client not just win, but do what's right, do what's fair. Because if you're in a market where the seller may not entertain anything, well, you need to use the limiting factors of a deal, the legitimate authorities. And at the end of the day, the lender's only going to give you the purchase price or the appraisal, whichever's lower, right?
Correct, yeah, because we can't lend on anything
so you can't
more.
lend on anything more. And remember, we were in a market not too long ago where people were overpaying for appraisals.
Well, and it paid for you to understand escalation clauses at that point.
Even more.
Yeah, because knowing both sides of the market and how you can utilize that towards your client's advantage. Nobody gets more concessions than you guys do. I don't work for
I
you
would
guys.
say that is a minimum requirement for me. Is how do I max IPCs first? Because that is funny money, right? Where there's an equity that I'm trying to realize for my client. And so, I love playing this game. That's why I call you the Warlock. So now we talked about VA, we talked about FHA, and I think as a borrower goes through their journeys, they, if they're veteran, they exhaust the VA loan and then, they want to utilize the FHA loan. But I think it's only a matter of time if you continue buying over your life that you run into a conventional loan. And because there's already a limit anyways. I think it's 10 you can only have.
Most investors 10 finance properties usually. Yeah,
and
once
then,
you go over the.
But does conventional fall into those 10 finance properties?
Yeah, any finance properties, correct.
Okay,
yeah.
so but eventually you will come across a conventional opportunity. So why is conventional really the backbone of the lending industry?
Well, it is actually a better program. First, I mean, once you get to 80% loan to value.
Okay, yep.
So once you have 20% equity in that home, you get to get rid of the mortgage insurance. It just, at 78% after 2 years, it automatically falls off.
Wow.
So if getting rid of a $200,
$300,
it can
especially
be expensive.
Florida.
Oh, well said. Yeah, I know. And then everything else is going up. It's nice to get rid of, and you don't have to refi or anything. Refinance.
Oh, wow.
It just falls off. By law. So that is the nice thing. I mean, even the story. A lady came in for a refinance one time, and it wasn't going to do her any good. Interest rate was better. But what I noticed that the mortgage insurance was still being collected 15 years later. Okay.
So how?
Yeah, it was just missed by the
servicer.
Yeah, exactly. So I told her, I go, honestly, that should have fell off. You should contact your servicer and let them know. They refunded her all those mortgage insurance premiums because it should have fallen off. So really, check it because.
Could you sue for that?
Well, I think that's why they refunded her. I'm
Immediately,
sure she
no
could have.
objection.
Oh yeah, I think that lady would have got like tens of thousands of dollars if she really wanted to.
Yeah.
But no, she just wanted to save some on the payment, and then she called me and just thanking me.
Look at that. So, that's like you said. First thing you do, call Chavez GPT.
I'm not looking. I don't even like mortgage lending sometimes, guys. Okay, at the end of the day, I just want to hold this market accountable, and it really bothers me the amount of people that are taking advantage.
Well, in VA, you talked about, they're a little bit more user-friendly when it comes to the credit score. FHA, I think a little bit higher credit score.
We'll go to a 580, which is
580.
Nice.
Yeah, they'll go less.
Yeah, FHA, correct.
But in conventional, I think there's some credit income, dynamic there. Is there? Because what makes it different? Because is it better than a VA loan for the credit score? But let's say I have a low credit score, but I have a lot of money, and I don't want to do the FHA because I'm going to put 20% down anyways because I have a lot of money, but I just don't have great credit. So high income earner that just maybe had a history of just poor credit, is there what makes the conventional appealing when it comes to your credit and income dynamic?
Well, so conventional is going to have a much sharper credit threshold than FHA or VA. Yeah, they're going to want you. The minimum is usually about a 620, 640.
Okay.
I will tell you, you will get penalized on that rate significantly, and you would be looking at quoting 6 and an 8. You know, whenever you get a rate quote. That's assuming 760 credit score.
Yeah.
Certain parameters, purchase price, So if you're lower credit score, and you may not even qualify for a conventional loan. You could get kicked out. Yeah.
Even if you're a big income and you have assets.
100%. We call it the 3 C's is the way I always learned it.
I thought it was the 4 C's.
But yeah. Well, the way I always learned it, good old Super Jumbo days at Wells Fargo.
Yeah, so Tom Brady.
Yeah, you have credit, right? So pretty common. You have capacity, okay, which is your ability to repay, which is income.
Yeah.
And then you have capital, which is your assets.
And then character.
They don't care. I don't think we can underwrite towards character. Thank goodness. But the credit's pretty easy. You have to meet certain credit score. That's your debts on your credit report. We only care about payments, and that's in relation to your income, which is the second C. So that's why we got into the whole 1099 stuff, because there's certain rules that, like, if you're W-2, pretty easy, 2-year work history.
Gotcha.
We get 2 years of W-2s. Self-employment, there's a lot of layers to that. Rental income, there's a lot of layers to that. VA disability income, so under these
non-taxable,
non-taxable income, foster care income, so all of these incomes are acceptable but they all have different guidelines that we have to abide by.
Isn't that wild?
Yeah, well, you have to have a
Yeah.
history and a continuance. That's what they're looking
History
at.
and continue. I love it when I hear these words.
Yeah, history and continuance is kind of what they're going for. So you have to have the history, 2 years normally, and you got to show that it's likely to continue for a year. A good example is VA, right? You're getting out of the military within the next 12 months. You should have started the home buying process at month 14.
Wow.
Okay, because if your LES expires within 1 year,
Yep.
the underwriter won't allow us to use that income.
That's crazy.
Yeah.
Even though they have the ability to re-enlist.
Good job. See,
Yeah.
Brian, you're an expert. Yeah, so then we have to get more documentation that says they do have the ability to re-enlist, and then you got to get a letter from command saying that they're eligible. But some borrowers, okay, are like, well, I'm not going to re-enlist.
Well, then, yeah.
Yeah, so you can run into problems.
I
that
mean, you
way.
always put it on the table, right? You got National Guard, you got the reserves, you know.
Yeah.
You got a lot of things you could do to
Well said.
re-enlist, to still get some income.
So you have that debt to income relationship right there. And so to get back to your question, always long-winded, but you're going to have certain debt to income max thresholds.
Wow.
Okay. VA, best of its kind.
It
I mean,
is.
You can go up to 70%.
Isn't that
you know?
crazy?
If you get people that tell you, like, well, my lender told me that you can't go, but that you can. Okay. You can absolutely go. They use a VA residual loan calculation. Okay, they check to make sure you have enough money left over at the end of the month. A lot of things go into it: family size, the taxes you pay, the size of the home. You know, so but that calculation is not as archaic as the debt to income ratio, and so it allows you. I've seen people get approved at 78% debt to income ratio.
Does the debt to income ratio in conventional change if there's a co-borrower?
No, so you're going to have a flat 50 on conventional. Okay,
Wow.
You will never cross that 50. And in fact, if you cross 45%, your mortgage insurance is going to go up.
But
so coming full
even
circle.
though, let's say someone has 50, but the other one has a 10, you know, debt to income, or one has like 55 and the other one has 10. I guess what I'm saying, it doesn't help if you have a co-borrower to help that let's say the main borrower is over the debt.
Oh, 100%. Yeah, we call them non-occupying co-borrowers as opposed to a co-signer. So non-occupying co-borrowers are absolutely allowed. And we take everything as a whole, okay? And so all the debts on the credit report, all the income, and that's how, so it's collective, you know? So absolutely it would help. And then, but for the credit score, 98% of investors always take the lower of the two middle scores. Gotcha. Or if you have four borrowers, they take the lowest of all the middle scores.
Wow. And you said borrowers. You can have more than two?
Oh, yeah. You can have upwards of 4. I think 8's the maximum. I've never seen it.
I have never heard that.
Yeah, but you can do 4. I've seen 4.
So you can have 4 borrowers on a conventional.
Correct.
Potentially up to 8.
Yeah, correct.
And conventional is only for residential.
Correct. Well, you can buy an investment property, but residential. Anything I would be talking about would be pure residential.
Pure
no
residential.
commercial.
No commercial.
No commercial.
No, it's incredible how that. Now, what would be, since we talked about VA, FHA, conventional, is it more likely that people refinance out of an FHA to conventional?
Correct.
Or is it better to refinance out of a VA to conventional in order to get that entitlement back?
I think there are opportunities to mix and match. Yeah. Because I'll give you an example. Let's say FHA. Okay, I just had an FHA streamline refinance. Okay, so FHA will do a similar thing to the VA loan. You know, you have VA IRRRL.
Yeah.
Well, you can do a non-qualifying FHA loan. Same way. Okay, and they'll do partial refund of the upfront mortgage insurance premium paid, depending on how long you've had the home, kind of thing. So sometimes it makes sense not to get out of that FHA loan, just do the streamline. Because if you don't have the equity to get rid of the mortgage insurance, you're going to get a bump in rates, so it just wouldn't make sense mathematically. And because that's the one thing I always say is, like, you don't have to listen to me. The math doesn't lie. Okay?
That's right.
The math doesn't lie, because we can just break down all the math, and if FHA makes more sense, which it would for this one lady for a streamline because she didn't have the equity to go conventional. Ultimate goal, though, is to eventually do the FHA loan, refinance that into a conventional once she has the equity, and then she doesn't have the mortgage insurance.
See, this is why I call you Chavez GPT, the warlock, because you need to be, as an agent or even a borrower, you need to be able to ask these questions. And I would think whatever's on your mind. Like, I feel like the more questions, the more creative questions you have, you're able to really get into you could say the SOP, the policy, the rules and regulation of a loan product, and really push it. Because it's honestly, I think because at the end, the check and balances is the underwriter,
Correct.
right? And making sure they're doing their job, but also making sure that they're looking at all different vantage points for you as the borrower. And that's what I love when I have a lender that I can go to and say, hey, here's the situation. Here's X, Y, and Z. And then I'm literally brainstorming, right? Because you are going to be limited. First, you limit yourself if you can't think like that. And then second, if your lender or lending team just can't provide these other options because they only have X amount of experience or they're limited by their lending status, right? Whether they're a direct lender, a correspondent lender, or a broker, yeah, you're going to be limited, and you can't in this market. So that's what I love talking about this. And so you guys just got a Costco free sample of just this is how we talk every day, and this is how you should talk with your lending teams. Now, in regards to other loans, right? Because we talked about the VA, the FHA, and the conventional, but there's one that old McDonald, I think, used called USDA. And one day when I buy a ranch, I think I want to use the USDA loan. Definitely have like a little Pablo Escobar ranch or something like that. But just, and it's funny, I never knew about it. And when I met Chavez, I asked him about, I think we were talking about Falcon or something like that. And USDA loan is, I would say, pretty competitive to the VA loan.
Oh, yeah, it's a government-backed loan,
and
so you're going to get rates.
And it's not really talked about because, it's in rural environments?
Yeah, it has no secret sauce in the world of lending, okay? So anybody can Google this, USDA eligibility, and it'll bring up a map, a tool lookup. And there's certain geographical areas that qualify for USDA loans. Well, I'm telling you, Colorado, we're pretty lucky. I'm native, born and raised here, okay? We all know you go east on Highway 24.
Yep.
You are all of a sudden in USDA territory, okay? So really, you got to look at the map because some things you think would fall in USDA do not, and vice versa. But again, that's why you call me. But there's also a USDA map you can look at, and that will tell you just punch in the property address, and it says it's eligible or not. Okay? And if it's eligible, there are some huge advantages with USDA loans. One, 100% financing.
Yep.
Only other kind besides VA. But then if the appraisal appraises over the value, you can use that towards closing costs.
Oh, my goodness.
Yeah, so that actually helps borrowers all the time. Now, a limitation, besides the geographical area, is household income, which is a little bit different.
But I like that, though.
Yeah.
Because you can account for the income of everyone in the house.
Correct.
So it's like a farm, like true farm family.
Yeah, your grandmother living there.
Yeah.
And it's not that they want to, they will.
Wow.
So because there's actually income eligibility requirements, too. You can't make too much money to do the USDA loan.
That's wild.
Yeah, so
even if it's expensive?
Even if it's expensive.
Wow.
Kind of thing. So
Because, what I've noticed in springs, unfortunately, we keep sprawling. But as we go out east, Falcon, I think at one point was USDA. Isn't it Peyton and Falcon? But then over time it's developed. And so now you have like regular homes with USDA loans.
Well, and take advantage of those maps not getting updated as quickly. That could be an advantage. Again, it pays to know. Knowledge is power. Okay, if I knew what I knew going in, and I can tell you when I go to buy my daughter's first home, it's just gonna
It's
give her every advantage.
You're helping my daughter when she's about to, like, what are you talking about? Yeah, you're helping all the daughters, all the sons. Speaking about USDA, I remember when you were working at a direct lender, and it was a bank, and you mentioned that you had a lot of history at USDA because they were pumping them out. They were like specialized in that. So there are lending entities for all the farmers out there, right, who want to be in rural country. Are there lenders that just focus on USDA?
The cool thing about USDA is that if the lender does conventional FHA, VA, 98% they do USDA.
USDA.
Yeah, because they're all kind of USDA just doesn't get talked about a lot. Mostly because even lenders are uneducated about it, unfortunately.
Yeah, but it's because of just the frequency. They're probably not in an area where USDA is an option or possible. Yeah.
Well, and I think that more like Canyon City, it's more prevalent.
Okay.
Fremont County.
Yeah.
It's more prevalent with some of the lenders down there.
And that's cool to hear because like areas like Canyon City have a trajectory to grow.
Yeah.
And if you can get in there with a great product and then, enjoy the wave, I mean, that's even better.
Oh, there's wonderful homes. My aunt has lived in Fremont County for 30 years.
Yeah.
So no, you just get it, but you're also going to get a wide variety of property types out there too. So it's something to be cognizant of. Manufactured homes, for instance, they're automatically going to carry a higher interest rate because they're considered inherently more risky than a stick-built primary residence. Yeah. But then not only that, there's a lot of rules and regulation. Okay, you can do a single wide, you can do double wide, but it needs to be affixed to a permanent foundation.
Yep.
And if you go FHA, it's going to need a foundation cert on it. The cool thing about VA loans is that the appraiser can sign off on the conventional. They kind of don't care. So there's a little bit less rules when it comes to it, but it again, there's all these layers to the onion, so it definitely behooves everybody to learn as much as you can.
Of course.
Because then you can ask the right questions.
Yeah, and again, think of this as your life is a Monopoly board. You're rolling the dice. You're going along your journey and throughout different parcels, right? Different little areas you're gonna land.
Well, imagine if you didn't have a game manual and you try to play
Monopoly. That's true,
Monopoly.
right? You're trying to play Monopoly.
No, we're a game manual, okay? That's what we do. Like, we're here to educate.
Oh, without a doubt. We talked a lot about loans. And like I said in the beginning, it's very dense, this topic. But if you truly want to find competitive advantage as an agent or a real estate professional, you need to understand purchasing power. And the last purchasing power is non-QM or creative lending, those bank statement loans that people talk about. And I'll tell you, this year, I think that is always on the table, especially when taxes become an issue, right? Especially when you have really diversified income, right? Coming from different areas, right? Whether it's your assets or it's some sort of, income coming in from your businesses, but then you may do some part-time or some contractual work. I think non-QM has a bad rep. So let's demystify, let's put it to rest. What do you think about non-QMs?
I think that non-QM has an excellent place in our market, okay? Because it really was designed for the self-employed borrower. I'm self-employed.
Yep.
You're self-employed. There are so many things that occur on our tax returns that can make it seem as if our cash flow is not there. And unfortunately, there's that magical 50% debt-to-income ratio on qualified mortgage loans, so that's where the QM comes in. And you don't have to deal with some of the rigmarole that you have to on a conventional loan, But that's not to say it doesn't have its own points of pain, right? Because usually you're providing 12 to 24 months of bank statements, which can be daunting. You're having to verify all those. So I think that they get a bad rap simply because a lot of lenders don't want to deal with them, to be candid with you.
But I feel like you would rather want to deal with them because of the less scrutiny, if you will. There's still scrutiny, but when you start getting into tax returns, right, and you already submitted them and they're already accounted for, then you have to redo them and resubmit them because maybe your lender at the time says, hey, if you fix your taxes, we could then, qualify you.
You have a terrible lender if they do that, bro. Okay, no, I'm just kidding. But all kidding aside,
is that the lender has to be knowledgeable in understanding people's tax returns so they can, one, be preemptive for, let's say they want to buy in X amount of months or X amount of years and they know there's that tax transition. Like, I think it's important to know, but with the non-QM not having the, let's say the requirement to provide taxes, to me is even better because all you have to do is make sure you verify your income.
Yeah, I think it's more so of a creature of habit kind of thing. Most lenders they know exactly what they're getting themselves into on tax returns, bank statements.
It's cookie cutter almost.
Yeah, it really is. Okay, because ever since the QM rules came about, I guess one of the blessings was everything became consistent. Okay, you knew exactly.
Yeah.
Non-QM is more inconsistent. The underwriters are probably going to ask for more verifications.
So much.
Yeah, so it does put the borrower through the ringer a little bit more, and I think for us as lenders, I don't even care if people use me. I want them to like me. I don't care. I'm a weirdo, dude. Okay, at the end of the day, as long as that person liked me, I am good. Okay, but if for some reason that even good borrowers, and we've all had those tough loans, where people got frustrated with you. That's the worst feeling for me,
Yeah, because you want good service. You want to make sure they remember how you made them feel.
But no, I'll be very honest. You pushed me to actually do my bank statements loans, and even at this point, I'm like, dude, I should do bank statement loans
all the time. All the time.
It's so true because once you learn those requirements, those became consistent. So it's fear of just learning
of the unknown.
New. Yeah.
We just didn't know, but. What I love about non-QM is when one time we had a borrower and the interest rate was a problem because it's higher.
It is,
right?
Yeah.
But like I said, IPCs, interested party contributions, you need to maximize those as best you can and get the seller to help buy down the rate. So what are some concessions that can be used in non-QM?
What I've found with non-QM, even though it's non-qualified mortgage, they're still following Fannie Mae.
Okay, so they use
VA,
some check and balance there.
Yeah, if you ever get into it where there's no rule, it usually defaults to Fannie Mae.
Gotcha.
Okay,
so
VA,
limiting factor, Fannie Mae.
Yeah, correct. So they're going to limit you on down payment as well, depending.
Yeah.
So probably about 6% usually.
But the point of the story is that when you get the concessions, you can still buy down your interest rate.
Oh, absolutely.
Pay different closing costs, and just have overall, I think, less scrutiny, than as opposed to the other ones. It's incredible, and I hope we're able to work more on those. And I love how you said it was designed for the self-employed. Mm-hmm. And so I think that is so important for small business owners. I mean, we talk about SBA loans for the commercial side, but what about when they want to buy their home, right? When that small business owner, let's say they open up a bakery, right? La Concha, right here in 80906. I would definitely check them out. But business owners like that who want to first purchase their house, but their taxes aren't that great, but they make good money, right? And they can show the cash flow, I think, a little bit better, or whatever the case is, but it definitely helps them. And again, at the end of the day, all these 5 loans, right, are so important in figuring out purchasing power. And remember, at year 1 when you start to year, at the end, you're going to have a lot of different experiences that I think are going to prompt an opportunity to use a loan product. So I think we could talk all day.
Yeah.
So I really want to do this last one, which is the lightning round, right? But it's lightning leadership round.
Oh, that's pressure. That's pressure.
So I don't care, what's your favorite movie, but what I do care about is what do agents often get wrong about lenders?
I think that agents really, it's not that they get wrong. They just won't learn what lenders go through. Mm-hmm. Even the pre-approval process. I would encourage any agent to just sit. It takes 30 minutes to go through a pre-approval. that 30 minutes would be the most invaluable 30 minutes for any agent out there. Just simply to understand what the lender is doing. And then you can kind of hold them accountable too. Like some lenders put more into their pre-approval than other lenders. And I think you have seen that probably. How many times have you had a loan go all the way to the end and all of a sudden there's a problem?
No.
Kind of thing. But then it would allow you to ask those more pinpointed questions. I get calls from agents all the time, okay, that are like, hey, I got a pre-approval for you. Can you tell me what this is, the borrower is about? Do you think I'm really going to tell you the truth? Okay, like, no offense to anybody, okay? I'm going to tell you everything that gets that borrower that home, okay? But if you're an educated agent, I know that right off the bat because you're going to ask me pinpointed questions. Like, have you looked at their income? Have you sent it through AUS, okay?
Ooh.
Dude, the moment you throw out an acronym to any lender, okay, they're going to be like, dude, this lady knows what she's talking about. So it would be really important to understand the role of a lender, especially you work with them more closely than any
other stakeholder in the transaction.
You need to communicate with your lender.
Always.
Okay, like 100%. So, and then I think as a whole, what I would recommend to anybody in our business is don't let it get to you. I will tell you unequivocally, this is the most stressful business that you can possibly work in. So find your coping mechanisms early and often, don't let it overwhelm you and utilize those resources that you have. Like, it's not just that your lender should be supporting you with loans, right? Like, they should be supporting you with your events. They should be supporting you with your clients. I've installed printers for people, okay, just so we can get their documents, okay? I drove to Pueblo, okay, to this title company because we couldn't get documents purged, okay? So, no, you need to really just learn what your lender does and communicate with them and show them that they're loved.
And it's not just the process to purchase is that there is a financing process, but it's your client experience. And the moment you introduce them to a lender, you introduce them to a title company, you introduce them to a contractor, who's at fault when shit hits the fan? No matter what, I don't care who you are, almost 2,000 transactions since 2015, the agent is always responsible. Why? Because they're directly communicating with you and you are introducing them. And I think a lot of agents kind of get scared of that responsibility because even though they're not the lender, they didn't tell them to sign any documents, they didn't tell them to do X, Y, Z, but they know that, hey, you told me to recommend these proven lenders. And let's say one of those lenders was a lemon, right? And it caused a problem. And then, like, you're right, you're at the closing and it's turmoil, right? And you did not pay attention to anything the lender did. See, that is scary for me. And I think at the end of the day, you're supposed to mitigate risk. And so the best thing you can do is put the position for the client in the best position to win. Now,
I'm a direct reflection upon you as a lender. They look at me as an employee of your group, okay? And I need to actually uphold that. That's actually probably one of the most important things for me. So, yeah, we just it's good to be able to work together.
No, and I love it when there's so many agents that are beginning to know who the Warlock is and literally how important it is for their business. And I know you helped a lot of agents, I think, elevate their business because of your experience and service. Now, why do lenders need to be educators and not salespeople? I think in this day and age, marketing has become so just a weapon right now that if you're not, marketing on social media or whatever the case is, that are you truly educating? Are you truly empowering clients? And I think the lender's role, in my eyes, should be to educate and empower, not to entertain, not to show off with the agent, because I think it's a very sensitive subject. Like you just spent almost an hour with me going over how much scrutiny the government-backed loans, the non-QMs expect to go and review under the hood of their borrower, right?
Yeah.
And so it's very sensitive, and so I think they need to remain educator. What do you think?
Oh, I think I look like John Candy, guys. Okay, I am not a salesperson. I think I built my whole entire business on education, and I do think that you earn more respect by being able to not just show you know your stuff, but you're actually passing that knowledge on to other agents too. And not just agents. I can tell you, it stuns me how many people, including lenders, think that the Fed controls our interest rate. You hear it all the time. Okay,
Yeah.
like, oh, the Fed cut rates, the rates are going lower. Mortgages are bought on the secondary market. Okay, so we follow that 10-year Treasury yield. Okay, that 10-year Treasury yield, if there's one piece of advice for everybody out there, see where your rate is now and monitor that 10-year, because if you go under 4 on that 10-year, you're opening up a ton. We're about to get into a really big world.
Tsunami.
Yeah, so, and it behooves us to watch that. That's an educational piece,
Yep.
okay? And instead of talking to a lender that tells you that the Fed is going to cut the rate, so you're going to save 0.25%, and then immediately after the rates go up. So I think it's very, very important to understand everybody's role, and that includes lenders. The reason I process my own loans, okay, is one, I need to understand it, okay, but I had a processor for a long time. I went back to processing my own loans because I didn't like losing control of the file, okay?
And I love that example because that is your supply chain, right? That is your, from widget to the storefront, if that makes sense. But for a realtor, every stakeholder is part of their process.
Yeah.
And if they don't understand where the borrower is stopping in the process, like you are just opening yourself to all that risk of just, oh, not my problem, not my lane. No, this is your lane, but you don't have any legitimate authority, but you're advising the client along the way and just making sure that the other party is actually defending them or promoting them or whatever the case is. But, this has been incredible. But I know you have some things you want to get off your chest, or you want to leave the audience with, a keynote. Do you have anything you want to tell the audience before we end?
More than anything, I actually appreciated the opportunity. One, I kind of sit in the shadows. Okay, I don't get out very often. I think anybody that knows me knows that. But I think it's super important to hold this market accountable. I really, really do, because so many times agents, it's a startling statistic, okay? 80% of people use the lender their agent recommended.
Yep.
Okay? They don't even shop.
Don't.
Okay? That's a scary thing. And there'll be nameless lenders, obviously, but it would behoove every person to just shop. And even one thing I'll say, so a lot of times you'll get lenders that will say, oh, here's my loan estimate. It's a closing cost worksheet, right?
Yeah.
Okay, it's not even the true cost of lending. So you got to be really good, trust but verify, okay? Really, it doesn't hurt you. And any agent, and you know this, Brian, that gets mad that you're seeking a second opinion, I encourage every client that goes with me to shop, okay? Just to add validity to what I'm telling them and showing, because, again, the math doesn't lie, kind of thing.
No, you're right. Options matter. And, I think the professionals invite accountability. I think they invite competition because at the end of the day, we live in a world where there are some bad actors and there's money involved. And so, you could say money, jealousy, root of all evil. And I love it when I do have the opportunity to compete, when I have the opportunity to interview, when I have the opportunity to earn your trust. And that's so important when you're thinking about, I'm going to buy a home. How do I assemble my Avengers, right? I'm a DC, so. But how do I assemble my team? And it's such a blessing to have you in this Colorado Springs market. It's been an honor to work with you for so many years. You're an incredible person, so much character, and I can't wait for 2026 and for all the people to get to know who the Warlock is.
Yeah. Well, anybody can call me anytime.
That's
I promise,
right. That's right. Call Chavez.
I have no
GPT.
life, dude. Okay, I know.
So, guys, if you love this episode, if you love learning about all the different loan products, listen, get on to the chat, get on DM us, make sure that you get involved into the conversations, the activities that are happening, because Duty Honor Real Estate is going to get bigger and better. So thank you again for tuning in, and we'll see you next time.